somewhat conventional wisdom, even at the early stages, are that, it's often kind of the smaller checks tend to punch above their weight. Um, you know, which has its advantages. Doesn't mean don't get a solid lead investor. Definitely do, but you can get kind of a lot of bang for your buck with some of these smaller funds, AngelList syndicates, and especially angel investors who specialize in kind of the thing that you're doing.
Hello, everyone, and welcome back to the Clean Techies podcast, where we interview climate tech founders and VCs to discuss all things building and investing to solve the biggest challenge of our generation, climate change. This is episode 85 of the show. I'm your host, Silas Maynard, and thank you for joining us on today's episode. If you are a returning listener, thank you so much for your support. And as you might know, we put a lot of work into making this show happen, so we are asking you to take 1 minute to help us today. And what we'd like you to do is send this episode to 2 people you know. So very specifically, one person that you think will like this content, somebody that really agrees with it and is interested in the space, and one person that you think might actually disagree with this content. Maybe somebody who challenges you at Thanksgiving dinners or things like that, right? We want to spread this word to a variety of people to help spread the word of what we are doing. So please do that. It would be very, very helpful. Again, also, if you're a returning listener, please leave us a review as, you're returning, so you must enjoy the show. So that would really help us as we continue to grow the show. Another quick note before we start to any founders listening. If you're a founder in the space looking for capital or partnerships, feel free to reach out to us. We're glad to help in any capacity we can, making introductions to help you further your vision. And then a big thank you to Next Wave Partners for making this show possible. Next Wave Partners are experts in talent acquisition, recruitment, and retention across the climate tech, renewables, and ESG spaces globally. So if your team is growing or you're looking to make a career change, feel free to reach out to them at next-wavepartners.com or reach out to one of their consultants directly via their LinkedIn page. All right, let's get into today's episode details. So today we are joined by Tommy Leep. So Tommy is the founder of Jetstream, a ClimateTech VC and VC fund investing in pre-seed stage startups. As a preface, Tommy is one of the first people I followed when I became interested in climate tech and the kind of ClimateTech VC ecosystem back in 2020. And I had asked him on the show a lot earlier in the days of the show, but it didn't end up working out. So, if he wanted to maybe see a few more reps and some credibility, so, get good on him. But as you can imagine, I'm very excited to have finally gotten him on the show. And so today we focus our conversation on 3 things. So first, some of his background and how he got interested in climate tech, how he got into VC, some of his challenges in his career. I thought that was really exciting for me. Obviously him being somebody that I looked up to quite a lot, and then being able to kind of hear the human side of him. The second thing we spoke about was his advice to climate tech founders who are fundraising at the moment, and especially in this current economic climate. He has some really incredible tips in this section, so you might want to skip to that if that's just your kind of main focus right now is to raise. That starts right around the 12-minute mark. And then thirdly, he walked us through his thought process for investing. So if you're trying to get a check from Tommy, definitely check out that part as well, as it helps you to understand what exactly he looks for when he's investing. That starts right around the 30-minute mark as well. So very, very fun conversation in general. I really do wish we had more time. Definitely have to have him back in the future. But without any further delay, let's get into the show. All right, welcome to the show, Tommy. How are you doing today?
Doing great. Thank you. Thanks for having me.
Absolutely. Really, really excited to have you. I think as a backstory for people listening, I believe I did try to get you on the show much earlier in the days of the show, but maybe it just took a little bit of consistency on my part to eventually get you on, right? And now you've got something that you want to talk about anyway. So I think the timing worked out. So I usually don't do intros for guests, but I'm just going to try to give a quick intro to catch people up to speed because we've got a lot to get through. So, and you can correct any of this if it's incorrect, but my understanding is you are a product manager kind of turned venture capitalist, started your career at Intuit as kind of the first real long-term gig that you had from your LinkedIn, eventually found your way into venture and then somehow drifted towards climate. I don't know if that was an intentional drift or just kind of accidental. And then eventually going on to found your own VC firm called Jetstream. So just really interested to hear, before we get into too much of the show, a little bit about this wandering journey. If this was something that you kind of had a goal from the outset, or you wanted to get to here at some point, or is something that kind of developed and evolved over time. it's very curious for me personally, and probably a lot of other people listening who are at the early stages of their journey and not sure maybe where they want to go. So I'd be really keen to start there.
Great. Yeah, no, that's pretty close. I think the one thing I would change is that the shift to climate was very deliberate. But to back up, I was in products and a little bit of marketing. I got, I would say maybe a big break by working with Floodgate, with Mike Maples and Anne Miyako there, who were just fantastic mentors, um, and opened up the world of venture to me. I didn't really know what it was like before, but just loved meeting founders, helping people out how I could using my network. I grew up in the Bay Area. I've been here for a long time, and a lot of folks and kind of things I've picked up in my time here. And so I just love helping founders along their way. So that was great. I had a little adventure in VC land for probably the 10 years after that, working with a few different funds, including Haystack, which is a great generalist fund. And then I was at AngelList for a bit. And in the fall of 2019, I left AngelList and I made an attempt to join a startup that didn't really, well, I joined the startup and then I got let go and it didn't quite work out as I expected. And I have no hard feelings about the startup. But it kind of gave me one of these blessing in disguise moments where I had a Monday morning of now what do I do with my life? And a close friend and mentor um, reached out, or I started talking with him, and we started talking about climate change. He'd been doing some research, and it really got me excited. I realized that not many VCs were talking about climate change, and I had a pretty good purview from my time at AngelList to know kind of what was going on. There really wasn't a whole lot in the VC ecosystem at the time. Again, fall 2019. Maybe Lower Carbon was getting started, which is cool. Another fund that I like and ended up doing some work with called Congruent Ventures was going. So I kind of declared I'm going to start investing in climate tech, meet everyone I can in the space. This was just right pre-COVID, so I was fortunate to meet a lot of folks in person here in the Bay Area, and wanted to be kind of a little ecosystem accelerator, and then started shifting all of my investments, which I had been doing through a syndicate, to focus on climate. So I invested early in Pachama and Cyanide Technologies kind of around that time. I kind of started doing some consulting work for Congruent Ventures, who I love and can't say enough good things about. They're really phenomenal early stage climate tech folks, and then fast forward a little bit, fall of 2021, I started raising my own small fund, and had a little bit of a mini snowball, and it turned into again. In this case, thanks a lot to timing and where we were in the kind of like the market trajectory at the time. But I raised a $10 million fund that focuses on pre-seed climate, mostly software.
Very nice.
So that's where we are now.
It's a pretty great journey. I'm kind of curious. One thing personally interested in is understanding. You mentioned that after the layoff, that you kind of had this Monday morning where you decided you had to ask yourself, what am I, what am I doing next? Was this something for you that you were just kind of head down all the way up into that point, and you didn't really, did you spend a lot of time or have like a certain methodology for thinking about, hey, am I in the right place throughout the other moves that you had made? I'm just kind of curious about that.
Yeah, I had, having kind of been in venture for about almost 10 years at that point, maybe 8 years at that point, and worked at other people's funds. I think the big thing I knew was I didn't want to go work at kind of yet another venture fund. I wanted to sort of figure it out for myself. I also think, maybe there's some reluctance to be like, okay, am I actually really a venture capitalist? Like, is this the thing that I do have to go do? And, kind of deep down, the answer there is yes. And I just needed to figure out how to do it and, get the courage to go for it. Um, I think, there's one other thing I wanted to share around that, but yeah, maybe it'll come back to me. It just
Yeah.
escaped.
Yeah, no worries. And I think it is interesting because I got into this space in 2020 when I started doing recruitment. And I do remember, I mean, obviously you mentioned that you had started really diving into this in 2019. You said fall of 2019. And it is crazy to think, like, having a second to look back, like how different the landscape is now compared to
Yeah.
then. I mean, there's so many funds, obviously really, really good stuff happening. So it's interesting to look back, and it's interesting to see how time flies. One thing also with this career journey, I'm curious to understand is, was there ever a period of time there where you were maybe uncertain about the future? Like, what was the hardest part of this whole journey of kind of before before now all the way up to now? Like, was there a specific time where you really struggled, and how did you kind of come through that, and what did you learn from it?
Yeah, great, great. I mean, yeah, the answer is yes. I worked at a venture fund that, I like to say had a rise and demise, called Rothenberg Ventures, and you can look that one up on TechCrunch for the story. So that was a challenging time. I was very fortunate that Samuel Shaw from Haystack reached out to me and was like, "Hey, do you want to come spend some time with me here?" He got me back on my feet. So he was someone who, yeah, it made a big difference in my career. I think the other time was, kind of after doing some work with Haystack, I actually kind of got into recruiting a little bit as well. I was helping people find work in tech, and I wanted to figure out, is like, can I work on the side of job hunters to help them find things that are really meaningful for them instead of working on the side of like a company, as a recruiter. And I really enjoyed that. That experience kind of led me actually to find a job at AngelList that really resonated with me in the kind of VC business development side, at AngelList. And that was one where I was like, oh, this, instead of giving this to someone else, I think this is a job for me. I think I'm a good
Yeah.
fit for that one. So yeah, I took that. And then there was sort of this like, okay, well, who am I going to be? Like, am I going to be a generalist investor? Am I going to compete with everyone else? Like all these incredibly smart people who, are way smarter than me at crypto, are way smarter than me at AI and all these other things? Or am I going to carve something out that I really care about, that I'll put energy into and understand? And so when, kind of this friend and I started talking about climate change, a lot resonated with me there. I grew up kind of here in the Bay Area. I've worked in Tahoe over the summers. Place I worked nearly got burned down once, from wildfires. And yeah, when I saw Greta kind of getting more prominent in the news, it really spoke to me, just about kind of how important some of these things are and how world leaders aren't taking it seriously. And then I realized, VCs here weren't really spending time on it. So there was a market opportunity as well.
Hmm.
And I knew I could be effective as someone who really likes to get involved in communities. I knew I could be effective as like a bit of an accelerator there. And I, yeah, decided like, okay, this is what I'm going to do. This is what I'm going to do for the next 10 plus years. And carve out my own little thing.
Nice, very nice. Well, I appreciate
But
that story of getting into the climate side of things. I was going to ask about that, so glad you covered that. Um, let's go into. I think it's a good point to shift, and I really appreciate all the context there. I think it's really interesting for people to remember that everyone is human. I think somebody, being somebody from the middle of nowhere in Wisconsin, I think it was very intimidating entering the workforce and thinking like, all these people, like they're just like super cool, they're super crazy, which they are, but they're also human, and we're all human, right? And I think I really appreciate you sharing that aspect. But want to shift over into a little bit about what you've written recently. So I think the first thing would be really cool to talk about is the piece that you published on your Substack about your tactics for fundraising for ClimateTech Startup. So could you maybe kind of go through some of these bullet point by bullet
sure.
point, and we can go from there?
Yeah, great. And I have it up here just so I can make sure I refer and touch everything right. So fundraising is high level. I just think really important. It's a thing that VCs talk to founders who are fundraising, every day, and founders, if they're lucky, they do it, 3, 4, 5, 6 times, kind of in one startup. So it's a very classic like information asymmetry thing where it's just really hard to know as a first time founder, but even as a repeat founder, um, you know, what should I do? What works? How do I understand kind of this market of investors? And so I've always appreciated when other investors that I've kind of learned from have kind of dropped knowledge, for founders on what works and doesn't. And then as an investor, kind of literally my favorite thing is rolling up my sleeves and helping founders in their investment, in their fundraising process, and just kind of understand what's the feedback, what are VCs saying. Let me help you decode that into what it actually means. Even yesterday, I was on a call with a couple of founders who are in the middle of a process, and they're like, this just happened. What do we signal to the next VC that we talk to, about where we are in the process? And yeah, I like that. I think maybe it's just because it's so much of an interpersonal game, but just kind of experience, that is so unique. So that's some context on, I love the fundraising process. And then as far as, my fund, I invest pre-seed and early. And so I like getting really involved in the seed and Series A rounds as a feeder to some of the top climate and generalist funds. So yeah, here are kind of my, I think, 4 tips. So stay lean. Instead of raising large, get a lead investor who focuses on your stage. Optimize for the investment partner, not the price. Bring multiple great investors into the deal. And then there are 5 actually. Bonus, build relationships this round for the next round. So yeah, if you'd like, I can kind of go into them.
Yeah, let's go. Let's just go straight into them one at a time.
Great. Yeah, so the stay lean one, I think this is a lesson from the market getting kind of rich over the last year and then coming down. Investors will often say, hey, raise 18 to 24 months runway. And founders will typically interpret this as like, okay, well, I'm going to just kind of raise as much as I can. Or, if it's a pre-seed round or seed round, instead of raising $1 million, I'll raise, $3 to $4 million. My point of view is it's wiser to raise kind of just what you need, which is often raise less, keep your valuation low, and then just focus on building the product and kind of getting the product to as close as product market fit as you can. Get customers, launch, iterate, and grow, right? So, I think the kind of conventional wisdom, money was available. So I think kind of by necessity, folks are probably raising a bit less now. And, some of the kind of, to make it a bit concrete, some of the companies, there's a company I saw that raised $5 million kind of coming right out of an accelerator and wasn't anywhere close to product market fit. They're sitting on a good runway, but, for their next valuation, they'll have to make super meaningful progress to be able to kind of fill what their next valuation is to own up to it. So I think that just puts founders in a tough position. I've heard some folks call it kind of just like the fundraising overhang. Like it's like you have to live up to this now, and it could be a lot of pressure. So it's nicer. And there's something also about being hungry as a founder, even in the sense of like, you don't have eternal runway. Like, runway is going to run out. And so, you have to get creative, and, constraint, is, great for innovation, right? So, raise just enough, don't go too crazy, and yeah, and good things happen from there.
Yeah, I mean, I think it's interesting to make sure the incentives are right. I mean, I've never obviously been in this situation, but I can imagine there's certain, dollar signs in their eyes, like, hey, we can get this valuation that's crazy and my company is worth this, especially if you're a first time founder. I can imagine it's just like intoxicating, the idea of raising more and getting all this hype. But sometimes you just gotta say, hey, wait, is this the right thing to do? And what are the second and third order effects going to be of this if we do this and we just like have all this time in the world to maybe do, get the product, the fit right? I think ClimateTech Startups, I would assume, have especially if it's a non-software product, they must have a lot more difficult time to do that as well. So I'm assuming maybe we could talk about that separately. But no, I think it's really fascinating, great advice from what I've seen other people talking about. And I think it's especially interesting given that kind of the necessity with the market the way it is. Like, yes, there is money still in climate to go into startups. We see the overhang from all the money raised over the past couple of years, but don't have to be irresponsible, because there's other companies that might also, well, certainly shouldn't say might, do need other capital, right? So we have a lot of things, because this is not just about making money here. It's also about saving the earth, essentially. So really appreciate that one. Let's go into the lead investor one. I think this one really fascinating.
Yeah. So, I think this I've just seen time and time again where, it's about incentive alignment with your own investor, and the risk being that you're just an option for your lead investor. So the idea here is get a lead investor who's focused on your stage. So if you're a pre-seed startup, get a pre-seed VC. If you're a seed stage, get a seed stage focused VC. If you're the other way to say that would be, if you're a seed stage startup, don't get a Series B focused VC, or even maybe a Series A. It might be too much. And the reason is that a seed focused investor will have a fund that is constructed so that each one of their seed investments has to be able to return the fund. And what that means is that every one of their seed investments, they basically put everything they can into it and helping them out, because it's one of the, maybe 20 or 30 companies in their portfolio that could exhibit a power law and return the fund. So if you're, say you're a seed startup and you raise from a Series A or Series B company firm, that firm will have like, a pretty large fund, and the check size, let's just say it's a $2 million check into your seed company, where normally they're writing $10 to $20 million checks in the bigger companies, they're just going to think of you as an option. And so they'll gladly put the money in and kind of wait and see, in the chance that, oh, it's Series A or B, maybe they can participate with the check that really matters to them. But they're not going to, kind of spend the time and put in the work. And they may not even be specialized to help at the stage that you're raising.
Mhm. Yeah, I think it's interesting to shift that mindset, because it's almost as, I feel like it can be difficult. I'm assuming in the fundraising situation where you just like, hey, I need to get the money. I'm at their behest, but in reality, you kind of have a limited number of dollars that you can intake. So make sure that those dollars are coming from the right person. That's going to help with the long-term strategy, right? And not getting just focused on raising the money. I would assume maybe have some tips on this, because I've heard a lot of people on the show talk about how it took them so many pitches to get their first dollars. Do you have advice on what order to reach out to people? Because I'm assuming you could rank kind of, hey, here's the potential partners that are in my specific round and in my domain. Maybe there's 10 or 15 of those. I don't know, the numbers, but if do they go straight to those 10 or 15 first with really tailored pitches, or do they go practice a few times somewhere else, right, before they go to that? Like, what's your advice there?
Yeah, it's great. So I do think it's healthy to have a fundraising process in this way, and basically have a sequence. The way I've done it with founders is we kind of have different waves. So you're kind of wave zero, we might call it, or actually some friendly fire. So VCs who are not your target, but who are friends of yours, or maybe friends of kind of one of your existing investors, who you can give your pitch to, and they can give you just kind of feedback, especially on clarity of the message, conciseness, and just like, are you getting the points across? So step one, I'm like, yeah, definitely go do kind of this friendly fire, get feedback from folks who, don't have as much skin in the game, but will help you out of, kind of goodwill. And then I think it's I don't think you want to do the primary targets next. You probably want to warm up a little bit, because I actually think of fundraising a little bit like a product launch. Like, you have all these ideas for, you've done some research on your customer, you have ideas for what the product should be, you build some features, now you ship it, but not really until your product is public, kind of in the market, do you know how people will actually react, kind of like in a real way. It's kind of like that. So you've prepared your deck, your story, you got maybe some data in a data room, and then you do a practice pitch, and then you basically go to the fundraising market and you kind of slam into the market, and then the market, VCs, investors, they tell you kind of, well, this doesn't make sense, or I don't really believe in this, or come back when you have more users or traction or customers. And so, especially in the beginning, I think you want to do 5, 10 pitches, kind of first time pitches with VCs who are not your number one target, because you'll learn a lot in that, which is the other piece, kind of the other similarity to a product launch is you need to take that customer feedback and iterate. You probably need to iterate on your deck, your story, kind of like the narrative. And it might be that you're fundraising for 2, 3 weeks, and not until then do you get the real click of the like, aha, oh, we should be talking about this in this slightly different way. And sometimes it even has to do with, maybe we should change the vision and strategy of the company, given what we've learned from some of these other smart people who have seen a lot of things. I had one of those last summer, and just like a slog of a fundraise, but we learned a lot in the process, and kind of came out with a slightly different business model using the same technology. And then good things started to happen. So overall, though, oftentimes these pitches can be, 50 plus first time VCs. And so, though it sucks and it's a lot of work and a lot of time, and takes a lot of focus and effort, you do want to find someone who is a great partner that you this relationship into for a long time. And it just takes a lot of work to kind of find that partner.
Yeah, no, I think that's really interesting. I feel like that's great advice. I'm assuming many people maybe haven't heard this idea. They maybe want to go straight for the whales, right? If that's what you want to call them. But I appreciate that. Cool. And I think the next thing on the list was optimize for the investment partner. Was that correct?
Yeah, yeah. Yeah, not the price. And so, kind of it's the we glorify how much a company has raised, and then often kind of like the valuation, and those are very measurable numbers, and we like to kind of wave them around, and it's like, okay, we raised 60 million at a 300 million valuation or something. And and then because there's concrete quantifiable numbers, we can kind of compare, and this is the thing humans do. But when you think about it, like, what really is the goal? And it's to find a fantastic partner for what your company does at this stage, and often kind of given the expertise of the investor. So I highly encourage founders to think, it's not about the best deal, optimize for the partner. The rest kind of takes care of itself. This is, again, somewhat assuming that you have some options. You have maybe a couple term sheets or a couple possibilities or people you're thinking about. But I don't know. I would love to hear counterexamples, actually, of founders who've said, oh, I'm optimizing for dilution because I think that's the most important thing. But I think realistically, it's not. It's easy for that like idea, the dilution optimization idea, to kind of get wedged in your brain. And so it's kind of like, yeah, flesh that out and go with, as much as you can. I call it a love connection for the partner. I don't know if that's like PC, but, as much as you can find like just like a really good, energetic connection with someone, I think that is actually much better than, just taking the best deal.
I think it's kind of interesting. I mean, I first kind of became interested in startups as a whole right around the time that I was like, we were watching WeWork crash. And I just remember thinking to myself, like, when I started learning, I was like, all these companies are, 10 years in the making. They keep raising more and more money, but they never make money. And I was like, this doesn't make a lot of sense, because I grew up working for my dad in a small business. So I was like, isn't it the goal to make money? It's not about a bigger valuation. And I think it makes sense to recognize, like, hey, there's a time and a season in startups. Every raise is kind of a different season, and you got to figure out what is the goal of this season to get to the next season, which is going to be a different goal, right? I think it's especially evident in hardware startups, because you have to do a certain thing, get your pilot, then you can go and scale, blah blah blah. It's like very, very different, but the goal is eventually to make a profit, not just to raise a huge valuation and exit as a founder, right? So I think it's interesting. I really appreciate the insight there. Cool. What was the next one? Was bring multiple great investors to the deal. Was that right?
That's right. So yeah, I think this is, there are, I think I saw some of the stats yesterday or the day before, but it was just like, the number of VCs kind of, I don't know, I'm going to guess, but it's like 2 to 3x every year over the past kind of 4 or 5 years. And there's just a lot of VCs out there. And so, the more that you can find VCs that are really great and can be like kind of complementary investors to help you with various aspects of the business, that's great. So kind of, I classically see a startup that will get maybe a generalist seed fund will lead the round, and then they'll pull in someone like me who's climate focused for, my network, my connections with other climate VCs, other climate founders, relationships to customers, and kind of other folks in the space, as a ride along check. And then maybe there's even one more. Maybe you kind of get smart about who the angels are. And I think kind of the somewhat conventional wisdom, even at the early stages, are that, it's often kind of the smaller checks tend to punch above their weight, which has its advantages. Doesn't mean don't get a solid lead investor. Definitely do. But, you can get kind of a lot of bang for your buck with some of these smaller funds, AngelList syndicates, and especially angel investors who specialize in kind of the thing that you're doing.
Mm-hmm. Yeah, I think that is interesting, especially if we're looking at climate, where there's a lot of very specific types of verticals where you might require certain expertise. That's interesting. Very cool. Fifth thing was build relationships for the next round. This round.
Yeah. So, kind of the moment of fundraising, you're lifting your head up from the hard work you're doing on your company. You're going out and you're having a bunch of meetings. And though it will be very time consuming, it takes a lot of effort to talk to a bunch of folks. it's nice to start those conversations with folks and who you're raising from this round, but also in the future, kind of at the same time, so that when you're done fundraising, you don't have to kind of continuously, start those relationships. So just use this chance to tell folks at a later stage about what you're doing. So again, let's say you're raising pre-seed now, and maybe there's some Series A investors for whom you might be a good fit down the road. Like, yeah, go talk to them too, because they might have ideas for like kind of how to improve your pitch or what they're seeing for companies that are at the Series A stage that you might want to think about as you're building, as far as kind of heuristics to hit. But yeah, I think it's just in general. I also view it as like an opportunity to kind of increase the surface area for luck or serendipity. There's just like a lot of unexpected connections you can make from people that are sort of at the edges of exactly what your target is. So feel free to kind of take some side quests and detours to explore this.
Yeah, I think it's interesting. I just read, I think it was last week, I finished reading Never Eat Alone, and it was that same thing as build the network before you need it. So I think that's pretty interesting,
Yeah.
interesting advice. It just so happens recently read that. So very cool. Well, I think that's very, very helpful. Some of these things never really heard anybody speak of, so I really appreciate that. The other thing I wanted to dive in, of course, before we leave is, could we talk a little bit about how you make investment decisions? I know you wrote another post about this, but just kind of help people understand like what's in your mind when you're looking at startups, especially at the earliest stage, and kind of help people understand what do they need to bring to the table to have you invest in them.
Yeah, absolutely. So, just as a founder is considering an investor, which would be, potentially up to a 10-year relationship, maybe longer, maybe you go into business in other ways in the future as you keep building companies. I have the same kind of outlook on it. It's like I'm choosing in a relatively short period of time, do I want to enter into a kind of business partnership with the founders? And so I have a few things. I try to keep it relatively simple so that I, am in a position to make decisions quickly. But the main four things are market, product, founders, and fit. So market, what's the potential for the market size and growth? Product, how's the product unique and defensible? Founders, how are they exceptional? And then fit, is it a good fit for me personally? Is it something that I get, fired up about? So yeah, I'll just dive into those. So the first one around market, basically with climate, I'm trying to be at the frontier of what's happening in climate change. So, where are relatively new needs or markets that are growing fast or have a chance to in the near future. And I like to share kind of a Mike Maples quote from Floodgate where he often says, is our market growing? Is our position in the market growing? If those two things are true, then good things will happen, assuming we don't mess it up. So, I would also say that I find the market question is kind of among the tougher ones for me because it's not always that the market is taking off already. It's kind of, we believe that it will in the next kind of year or two or three. And sometimes, sometimes I make the right call in there and sometimes I don't. But that one's predicting a market is hard, but
Yeah.
it's kind of important.
Do you have certain criteria if you're looking at a software versus a hardware product to determine kind of like, hey, what is the lead time we need here to, because obviously if there's R&D involved at all, if you're at this early stage, you're going to need more lead time to be at the right timing of the market because you can't just spin up. It's not just the software. So do you have any different ways that you view those two things?
Yeah, I mostly do software. So I mostly invest in software. And with the software companies, usually I'm looking for like, do you have a path to, do you have some customers? Do you have a path to a few customers? Is there a chance that you'll be able to win some of the bigger customers in this space, even ahead of kind of anyone else who shows up in the market? So it's in software, it's kind of a little bit more kind of clear, I think, linear in a sense. With hardware, kind of the classic things. Hardware is hard. You think it'll take 3 months. Multiply that times three. I think all those kind of sayings are true. So I'm less rigid about kind of like hardware prediction and timelines. Usually with hardware, it's more that if we're successful with this and we're able to build a company and capitalize it and get to delivering the product, do I believe that this will kind of radically reshape the market or displace other companies in the space because the solution is that much better. So that could be, it's labor saving, it's time saving, or, you know, it's higher resolution, or it's kind of more continuous data, um, things like that.
Mhm. Do you measure anything specifically against when it comes to market based off of the areas that need to be decarbonized and how many, investors are getting into those spaces already? Is it oversaturated? Is there any specific criteria because of the climate angle that you apply?
Yeah, I would say there are kind of a couple of things. So one, I think a little bit about the maturity of the market. So for example, I mentioned Pachama and Sinai, which are, you could kind of call it a carbon offsets company and a carbon accounting company. And so, you know, um, I think both of those, I wouldn't call those markets mature, but they've evolved sort of beyond where I would make an investment in them now. So there are kind of a few big players in each one. Certainly someone else could come along and, maybe win the market. I think somewhat unlikely, but, those are maturing. And so I wouldn't make a new investment there. So there's some kind of assessment of, where are we on the progression of this kind of market. I think the other thing that comes to mind is you sort of mentioned the like, was it carbon measurement or CO2 emissions measurement? I'm not sure if that's what you meant, but um, yeah,
Meant so
I
more
would
so
kind of
on the side of things where when we have this a rough idea of which industries are emitting and which need to be solved, and then if
right.
you kind of apply that lens to the investment, say, hey, transportation's handled. I'm not going to worry about that space. Let me focus on another one.
Yeah, so I'd say probably explicitly no. Like I maybe not a popular opinion, but I'm not kind of like a carbon maximalist sort of in that sense, and or carbon reduction maximalist in that it's not just all about I don't apply the like John Doerr like
Mm-hmm.
here are the areas, here's the CO2, here's kind of like the drawdown kind of layer. And there are funds that are doing that. That makes sense. I think it makes sense for bigger funds that can kind of more
Yeah.
clearly measure the impact of their startups at the stage, at Series B or C stage. But with me in the pre-seed, it's much more subjective. Um, it's I care about. I like to see forecasts of what emissions reductions could be. I want there to be a sustainable or um, kind of emission reduction lens. I actually care more about like why is the founder doing this? Kind of what's their purpose? What's their kind of personal alignment or goal to have happen here? So it's more of that story that I'm interested in. Um, but there does have to be a climate story for me to kind of be
Mm-hmm.
involved in the first place. One example though is like it's so hard to pre-seed because we almost expect companies to like pivot or do end up landing somewhere else with product market fit. So one quick example, I think I shared this in the post, was the startup called A to B. It started out as a service for people who basically kind of the Google bus for everyone else. So if you live in San Francisco, you can get on a Google bus and get taken down to Mountain View. That's basically, if you live outside of San Francisco, you can get on a bus and get brought into San Francisco to work at Stripe or, maybe the Facebook offices there or something like that. And the founders had done a ton of research on this. Normally I wouldn't invest in a company like this because it's like they're leasing buses and it's kind of a little capital intensive, or I just didn't really like the model. But the founders had done so much research. There was a bit of a kind of a carpooling climate angle. I guess I kind of liked it. But really the compelling thing was like, well, these are really proficient people who have like understood this industry in a very deep way. Then COVID hit. No one's taking a bus. No one's no one's going into the office. And so they had to adapt. And they built kind of a digital payments business for kind of trucking and
Mm-hmm.
maybe just generally the mobility industry. Not as much of a there, but the company just took off, did really well in a short period of time. I hope that they come back around to climate and they can enable electric vehicles, or they can enable kind of like the investment of fleets into EVs. But
Mm-hmm.
sort of we'll see. So would I not do that investment now? Maybe not. But am I happy that kind of the LPs that invest in that one can benefit from it? Like, of course.
Mhm. Yeah, certainly. Yeah, I think we're running a little bit out of time. I'll let you maybe go quick
Okay.
shot through the last three, and I want to make sure I get one last question at the end.
Okay, great. Let's do product. I think the big thing on product is, I'm looking for, um, I call it uniqueness. I think other folks also call it differentiation, but it's kind of like, how is this thing truly unique? Is it something that only these founders can do and other people can't? Um, is it something that can't, some other thing that can't be copied? I think generally features can be copied, but is there some other piece of this whole thing that is unique? So that's like been a major thing for me, especially as a few of these markets around climate kind of do mature. Something else has to be like, okay, well, this is just like very, very different and unique, and that's sort of interesting for me to invest in. For founders, looking for some bit of exceptionalism, um, which I think is kind of a fairly kind of typical trait. But I think lately, and maybe slightly more controversially, I'm kind of more into finding founding teams that have more than just one founder. Um, the controversial aspect here is that like a lot of founding teams, often the reason the startup fails is that the kind of founders have disagreements and the team kind of blows up. But I think the flip side of just one founder, I think it takes a lot to really go the distance with a company. And it's really helpful to have people committed from the beginning with complementary skill sets. So it's sort of a thing that I'm paying attention to and trying to learn a bit more from now. And then I'll touch on fit, kind of the last piece here. It's just, am I fired up about what this company is doing? Is it, after I hear the pitch, after I look at the numbers, I sleep on it and kind of think about it for a few days. And do I keep coming back to it? Am I like, yeah, do I think these people are doing something cool and I would really like to be a part of it? That's important. I think as I've started doing my own investing, the main purpose that I've been trying to invest on my own is actually to be able to close my own feedback loop and figure out what works and doesn't work for me as an investor. And the fit piece is crucial because I want to be in business. I'm at the fortunate position to be able to choose who I want to be in business with. And so for me, it's kind of all like really important to listen to, like, are these the kind of people that I want to start this potentially 10-year plus relationship with?
Yeah, no, I think it's really fascinating. The way you look through these things, I appreciate having the framework for it. I really think there's a lot of really great insights here. So I really appreciate you coming on the podcast. I do want to wrap up with one thing, which is, I guess, generally speaking, your advice to those people either already in the process of building a ClimateTech startup, or maybe they want to do something but they're not exactly sure. Like, what is your advice to these people, especially there's going to be tough times ahead? Just your kind of thoughts for them.
Yeah, I mean, in general, for founders and people exploring, like, just allow yourself to have that curiosity, kind of like accept your interest there, and keep pulling on the thread. Yeah, I think that's a high level thing. I think it's it's just really easy. Maybe especially kind of a bunch of people have been laid off recently. Maybe capital markets have tightened a bit. Like, it is scary. Like, it just is. I was gonna say it's easy to be scared. It's like, well, it is actually scary, and it's hard. It's hard for a lot of people. But don't let if you got even a tiny little voice in there that's saying like, hey, this is cool, let's go check it out. Just let yourself listen to the voice, and yeah, because it'll keep being there until you do. So yeah, let yourself listen to it, and possibly good things will happen.
Yeah, and I appreciate that. I've had several people I've bumped into, even some former coworkers, who they said that once they kind of got that bug, they just couldn't shake it, right? they maybe tried to, and they said, no, it's too hard. But no, I appreciate the advice. Again, really, really insightful things that you've mentioned here. So I appreciate it. Where should people follow you and stay in touch?
Yeah, so I'm on Twitter. It's LeapNet on Twitter, and then I'm on my website is jetstream.io, and you can email us from there. And yeah, I think that's kind of the way to do it.
All right, very good. Thanks again. Have a good rest of your day. All right, thanks so much for listening to today's episode. If you enjoyed it, please do share it with somebody who might find it interesting. Give us a review on Apple Podcasts. It really, really helps us to get better rankings, and I appreciate, again, if you like the show, please show that publicly. It's really, really helpful. And feel free to reach out and connect with Tommy. You can follow him on Twitter. It's probably the best place. He's also pretty active on LinkedIn, I think. And then check out their website. Check out the Jetstream website to learn more about what they're doing. And if this is your first time, please do subscribe and tap the bell for notifications. Quick note, our next episode. So next episode, we'll be joined by Joe Bushnell, the founder of Azolo. So they are building a services business and an insights platform that helps companies, especially corporates, upskill their entire workforce to understand ESG. So the idea behind it is, if a company is going to undergo true transformation to be in alignment with the ESG space and the sustainability kind of mindset, their entire workforce will need to understand ESG to a certain level. You can't just have, a team of 5 or 6 people in a company of 100 to 200 people who are focused on the ESG aspects, right? You need to have everyone at least participating and understanding it and why they're doing it. So this is a really, I think, a very interesting need in the space. The conversation was really fun. I mean, we covered his journey making the leap from consulting to found a ClimateTech company. He, including finding the problem actually to solve, because he didn't have one in mind when he left his consulting role. And then we talked about their tech, the process that he went through of building the company to where they are now, and a little bit about his views in the future. So really, really fun episode again. Quite enjoy this one, so stay tuned for that coming up next. And thanks again, as always, for joining us on Clean Tech is the podcast. We will see you next time.